As the holiday season winds down and markets return to full speed, newly released government data is giving us a clearer picture on the economy. Despite delays, the numbers show economic growth in Q3 came in stronger than expected, while the continued rise of the gig economy is quietly reshaping what we're seeing in unemployment claims. Good afternoon. I hope you had a great holiday weekend. Between travel, family, and everything in between, last week flew by, but we are back. With the holiday in the mix, last week was relatively quiet in the economic front. Markets were closed on Thursday and operated on shortened sessions Wednesday and Friday, but there are still a few important takeaways as we head toward the end of the year. As always, the biggest factor to watch in the markets is inflation or inflationary pressure, as it plays a major role in the direction of mortgage rates. Why? Well, when you get a mortgage, your loan is bundled into a bond and sold to investors. Those investors are effectively lending money for 15 to 30 years, so they care deeply about what that money will be worth over time. That's why inflation is so important, and simply put, if you want to understand where mortgage rates are headed, keep an eye on inflation. With that said, let's dive into what took place last week. Here are your headlines. After a delay caused by the government shutdown, the first estimate of the third quarter 2025 GDP was released and it exceeded expectations. The US economy grew at 4.3% annualized pace, well above the 3.3% forecast. Growth also accelerated from 3.8% in Q2 and marked a sharp rebound from the 0.6% contraction in Q1. Through the first 9 months of the year, the economy is now averaging 2.5% growth. So, what is the bigger takeaway? GDP is one of the clearest indicators of overall economic health, capturing consumer spending, business investment, government spending, and net exports. Consumer spending is one of the largest driver of the GDP and was particularly strong last quarter, helped by a surge in electric vehicle purchases ahead of the EV tax credit expiration at the end of Q3. Stronger exports and increased government spending also contributed to growth, helping offset softer investment activity. Additionally, a decline in imports, which count as a drag on GDP, provided an extra lift to the overall figure. A stronger GDP reading signals a resilient economy, which supports housing demand but can also keep mortgage rates elevated if inflation remains sticky. Now, in the labor market, initial jobless claims declined by 10,000 in the latest week, with 214,000 individuals filing unemployment benefits for the first time. Meanwhile, continuing claims, which track those still receiving benefits after the initial filing, increased 38,000 to 1.923 million. So, what is the bigger picture? Initial jobless claims remain relatively low, likely due to seasonal factors such as employers delaying layoffs ahead of the holidays, along with the growing influence of the gig economy. More displaced workers are turning to contract or apt-based work instead of filing for unemployment, as benefits often fall short of covering housing, living, and insurance costs. Meanwhile, continuing claims remain elevated near 4-year highs, a pattern that typically emerges when hiring slows and workers stay on benefits longer. This mixed labor data suggests the job market is gradually cooling, which could help ease inflation pressures over time and be supportive for mortgage rates. As we head into the new year, the latest data shows the economy remains on solid footing for now, while the job market is slowly cooling, both key factors in where mortgage rates may head next. This week, we will see updates on pending home sales and home prices, along with insights from the Fed Reserve's latest meeting and the newest jobless claims report. Markets will be closed on Thursday for New Year's holiday, making it a shorter week, but one that can still influence rates. I hope you enjoy the rest of your 2025 year, and I will see you in 2026.